Hey everybody, it's Will at VIP Mortgage. It's time for your local lender update. The Fed met last week, and as expected, they cut rates by 25 basis points, and the market reacted sort of negatively. And to understand why, and also to understand kind of why we're stuck in the pattern we've been in since September, we need to take a flashback to this time last year. You may recall that the Fed initially started cutting rates post-pandemic in September a year ago. And after that, mortgage rates went up. And the reason that happens is because when the Fed cuts rates, that is not mortgage rates, that's the overnight lending rate for banks. When that happens, mortgage rates often follow, but there are a lot of factors that impact how much people have to pay to borrow money. One of the things that came out of last week's Fed meeting is that going forward, the path is a little bit murky. And the reason it's murky is because now the Fed is in wide disagreement on what is going to happen next, not just economically, but what they need to do with rates to keep things from getting too hot or too cold in the economy, which is really why they changed rates at all. And the range is some Fed members think we ought to be raising the rate. Some think we ought to do 1 to 2 cuts next year, and some think we need as many as 6. That's a really big range of opinions on the right path forward, given that they're all working off the same data. Speaking of data, another big piece that came out of that meeting is that the Fed chair believes that we have lost 60,000 more jobs per month all the way back to June. So that's a lot more job losses than have been previously reported. And that's a big deal because our economy is based on consumer spending. 70% of the economy, in fact, is consumer spending. So if consumers don't have jobs, they spend less, which will slow down the economy, which means companies may feel they need to lay more people off because they're not receiving as much revenue from those consumers. So we're in an interesting place right now. And the forecast is a bit murky. To make that even more complicated, the new Fed chair will probably be announced in the next week or two. That person won't take over until May. And meanwhile, as we come to the end of the year, it's that time of year where lawmakers and policymakers go on vacation. They don't say much. A lot of investors stop paying attention at the markets. As I've been saying for a long time, I think the rates are just going to hold steady. If you go back to September, rates have basically never been better than that improvement we saw right before the Fed started cutting rates. In between, we've seen 3 or 4 times where rates come back to that same level, meaning they've come back down when it comes to mortgage rates. But in between, we have a week, sometimes 2, of rates being a little bit higher than that. And then we get some good news and things come back down. I still think the major factor is jobs. The overall health of the economy is so interconnected with the job market that I think that will be the main motivating factor. And then last but not least, from last week's Fed meeting, the Fed changed its policy on their balance sheet, and they are now, instead of letting the debt they bought run off and being sold in the bond market, they're now buying a little bit of debt. That's called quantitative easing. That's another thing they can do to bring mortgage rates down. So once we get into the new year and we get the end of the year numbers and we filter through all the data that didn't come out during the government shutdown, I think the bias in 2026 might be toward additional rate improvements, but I think they're going to be much slower and much smaller than people have been hoping for. If there's anything we could do for you, give me a call, 719-232-7553.